Okay, so hello everybody. This is part 3 of chapter 9. So we left off talking about the constant growth and capital asset pricing model methods to determine your required return or your cost of common equity. And we noticed that you can use either one, but it turns out that either one is different. So the capital asset pricing model technique differs from the constant growth valuation model in that it basically it considers the firm's risk, and that's the firm's risk is reflected by beta, right? As we know by now. So beta is important. So it's reflected by beta, and whoops, why does that do that? Uh, Okay, so that beta helps you determine the required returns, common stock equity on that common stock. Now, the constant growth model does not look at risk directly, right? It uses basically it's an indirect approach. So let's highlight this, right? So, uh, having trouble this morning here. It uses an indirect approach to infer what return shareholders expect based on the price they are willing to pay for the stock today. And that's all based on the estimate. Now, that's the important word, estimates of the firm's future dividends, okay? So there's these two different methods, and they vary, and it's very rarely they'll come out with the same conclusion as far as your required return goes. Okay, so basically with common stock equity, again, I said, remember, flotation costs is what you got to pay the investment bank if you're doing an IPO, right? And they increase the cost of common stock equity, right? Because that's money you got to pay out. Now, here is the cost of a new issue. Now, this is important. This is a new issue of common stock, right? This is a new issue. And this differs from the existing issue that we already talked about. So that's important, right? So the cost of common stock of minus the underwriting and associated flotation costs are as reflected here. So let me, if I could not have problems this morning here. See if I can get the highlighter to work. I guess it don't. All right, well, whatever. But remember, this is a new issue. So at least maybe I can get that to work. That worked. And that worked. All right, so that worked. So see, it's a new issue of common stock. And again, it's net of underwriting pricing and associated flotation costs, right? So here's the equation with the assumed growth of the dividend. Okay. And this is what the cost is for the new shares, right? All right, and basically based on the right. So here's an example in the constant growth valuation. Duchess required return on common stock RS was 13. Using the following values, an expected dividend and a current market price of 50, and expected growth rate of 5%. They've estimated that on average, new shares can be sold for $48 a share. Thus, Dutch's shares will be underpriced by $2. A second cost associated with a new issue is the flotation cost per share that would be paid to issue and sell the new shares. So the total underwriting price with flotation costs and the fact that it's underpriced will make the cost be $350. The total flotation cost and flotation costs will be $350 here, right? So this is what it's costing you to push this out. All right, so here's that new price, right? So you're subtracting the $350 from that price, right? And here is the dividend, $3.99, and here's your growth rate. And basically that says your required return on a new issue will be 13.58%. Okay, so that's basically, again, this is for a new issue. Now the cost of retained earnings is equal to the required return on your regular common stock, because you already have issued that already, right? So this is important, and there's no equation here. All you got to know is hold on. So all you really have to know is the cost of retained earnings is equal to the required return on your regular common stock. So nothing gets simpler than that, right? Nothing gets simpler than that. So here's another example that you could go over, right? You can just go through this, and there's some basic math here, right? And basically, here's an interesting thing about retained earnings. All right, so now there's another equation here, and this is an important equation, and this is called the weighted average cost of capital. It takes into account all the capital you have. Here is debt. See the small d? This is debt, and you can see it's after tax, right? And here's your preferred stock, and here's the weight of your common stock, and you have the return on each, whether this is new or existing stock, right? And all you do is multiply that, and then multiply that, and multiply that, and you just simply add them up. And again, the weights always have to add up to 1, right? The weights have to add up to 1. All right, so the weights must be non-negative, and again, they have to add up to 1. And the weights are based on the market value of each source as a percentage of the total you have, right? So if you got 30% in debt, that would be 0.3, right? All right, and you just multiply the firm's stock and by the return, and basically, as I just said, here is the fact for debt that it's after tax, right? So this is kind of important. Let's save all this, right? I made some changes here. We'll save that. So it's just a simple, some simple math there. So you can clearly see here the debt after tax, right, is 4.88 from previous examples, right? And here's the preferred stock, and here is the common stock. So basically, you would just sum those up, right? And you get the weights. You got to get the weights of each, right? So you get to what percentage is in what, and then you simply multiply those together. All right. So here's the weights we talked about, right? So this is the weights, the given weights, and that's that. And you just go through the math here. So the answer, when you multiply everything, you should get 9.28%. That's it. So that takes care of that. So here's the actual math itself, right? Here's the actual math itself. 0.4 up to 1. Here's the cost. And here's the weighted cost. All right, so basically there's these capital structure weights that we have to worry about, and all right, so that's about it for chapter 9. If you have any questions, feel free always to contact me.